Okay, over 9,400%. That is literally the staggering 10-year total return of sterling infrastructure. I mean, it's an absolutely massive number that instantly begs a pretty fundamental question, right? How exactly does a company achieve this level of extraordinary wealth creation? And maybe more importantly for us, what does the underlying data actually tell us about where it's going to go next?
Because that's the real tension we're dealing with here. We've got Sterling Infrastructure's undeniable, completely meteoric past performance on one hand, and on the other, well, a potentially overheated current valuation. If you're looking at this stock today, you really have to ask yourself, am I buying into a compounder that still has plenty of room to run, or am I paying top dollar at the absolute peak of the cycle?
So welcome to The Explainer. Today, we're diving into STRL, the anatomy of a multibagger. We're going to completely dissect the fundamental drivers, the operational efficiencies, and yes, that premium pricing behind Sterling Infrastructure. We're sticking strictly to the data to understand the exact anatomy of this massive multibagger stock.
All right, let's dive into this roadmap. Today we're covering 5 sections. 1. Explosive returns. 2. Growth engine. 3. Profitability. 4. Valuation premium. And 5. Fair value and safety margin. Let's kick things off with Section 1. The explosive historic returns. Just to understand the current hype, we have to look at the sheer momentum here. In 2023, STRL posted an incredible 168% return. And if you thought, hey, maybe that was just a fluke or a cyclical peak, well, the momentum carried right into 2024 with over 91% growth. Even now, the year-to-date figures for early 2026 are burning incredibly hot, up over 65% already. It's like the market simply cannot get enough of this stock.
Moving right along to Section 2, Growth Engine, Revenue and Income.
You know, behind every multi-bagger stock is a serious compounding growth engine. When we check out the 5-year compound annual growth rates, or CAGR, we see that top-line revenue grew at a very solid, respectable 15.2%. But the real magic, that happens further down the income statement. Net income absolutely exploded at nearly 47%, and earnings per share skyrocketed at almost 69% over those same 5 years. The crucial takeaway here is that they aren't just selling more stuff, they're demonstrating massive operational leverage. They're basically squeezing exponentially more profit out of every single new dollar of sales. And to put those percentages into perspective, they translate into some massive absolute numbers today. Over the trailing 12 months, STRL generated nearly $2.5 billion in revenue. But more importantly, they pulled in over $290 million in net income and an incredibly robust $362 million in free cash flow. I mean, this is a cash-generating machine that is just firing on all cylinders.
Okay, Section 3, Efficiency and Profitability Metrics. Before we throw more numbers around, let's take a quick educational pit stop on ROIC, or Return on Invested Capital. Honestly, if you want to know how well a management team is actually running the business, you look right here. It's the ultimate test of their ability to allocate resources efficiently. A high ROIC basically means the company is incredibly effective at turning its capital into highly profitable growth. And this brilliantly illustrates exactly what we're talking about. STRL's current ROIC sits at a stellar 16.23%. Compare that to their 5-year average of 12.4%. So their capital efficiency hasn't just been maintained while they grew so fast, it's actually improved by nearly 31% compared to its historical average. They are literally getting better at making money as they get larger.
Actually, scratch that. What makes this efficiency even crazier is how they financed it. They achieved all of this explosive growth while massively de-risking their balance sheet. STRL's debt-to-equity ratio has plummeted to a very healthy 0.26. That's nearly a 49% drop compared to its 3-year average. So they're generating highly profitable growth without bearing themselves in leverage.
Which brings us to the bear case pivot in Section 4, Valuation, Analyzing the Premium. So we've established the business is fundamentally fantastic, but the data strongly suggests the market already knows this. To understand the premium we'd be paying today, we need to look at a few multiples, including the PEG ratio. Just as a quick refresher, the PEG ratio takes a stock's standard price-to-earnings ratio and divides it by the growth rate of its earnings. It's an absolutely essential metric because it tells us if a stock is overvalued even after we give them full credit for that massive growth we just talked about.
Now, what's really interesting about this data is the stark contrast. When we put the current valuation multiples side by side with their 3-year historical averages, we see a massive expansion.
The PE ratio is up to roughly 54 compared to a historical 28. The PEG ratio sits at 4.14 versus 1.56, and the price to free cash flow, that's over 43 compared to just 23 historically. Literally, almost every major valuation multiple has practically doubled.
I mean, let that sink in for a second. STRL's current PE ratio of almost 54 represents a nearly 94% premium over what it typically traded at just over the last 3 years. Investors today are actively chasing that historical momentum, and they are willing to pay almost 54 times earnings just to own a piece of this company. For sure, that is an incredibly steep price for admission.
Finally, let's wrap this up with Section 5, Fair Value and Safety Margin. So what does this historic valuation premium actually mean for the current share price? Well, here's the stark reality laid out in the data. When we model out the projected cash flows, the discounted cash flow calculated fair value price for STRL is roughly $377.78. Yet the stock was recently trading at a closing price of over $505. The market price has clearly completely decoupled from the underlying intrinsic value model.
And because the price is run up so aggressively, the data calculates a negative margin of safety of nearly 34%. In value investing terms, this means there is essentially zero room for error. If management stumbles even a little, if margins compress, or if growth slows down, that negative margin of safety means the downside risk to the current share price could be absolutely substantial.
On top of that, this premium pricing has severely compressed the yields for anyone buying in today. The free cash flow yield is currently sitting at just 2.34%. That is a massive 71% drop from its 3-year historical average. Similarly, the earnings yield has shrunk to just 1.88%, down over 56% from historical norms. You're just getting significantly less cash flow and earning power for every single dollar you invest at these current levels.
So what should you really take away from this explainer? Well, it's a classic market paradox. On one hand, Sterling Infrastructure is demonstrating a practically flawless growth engine. We're talking expanding margins, brilliant capital allocation, the whole shebang. But on the other hand, the data proves it is trading at a historically high, unyielding premium with a totally negative margin of safety. So, is this a business so good it defies gravity, or are we staring straight at an overvalued peak? The data's all right there. What's your move?